Hey everyone, wake up. This isn't just another financial forecast. This is a 5-alarm fire drill for your wallet, and it's about to hit millions of Americans square in the face. We're talking about your health insurance, the very coverage that protects you and your family. If you buy your own health plan, especially through the Affordable Care Act marketplace, then listen up, because a financial tidal wave is heading your way and it's scheduled to crash on January 1st. Many of you will get the first horrifying glimpse of this disaster in your mailboxes next month. Picture this. You open a letter in October and your monthly health insurance bill, the one you've been paying for years, has suddenly doubled, tripled, or even quadrupled. This isn't some far-off possibility. It's a very real threat for roughly 22 million people nationwide. The enhanced health insurance tax credits, those critical financial lifelines, are set to vanish at the end of this year. If Congress doesn't step in, and do it fast, your healthcare costs are about to go through the roof. The numbers are staggering, and they're not just projections. They're already starting to become reality. Health insurance premiums for many Americans are poised to jump by an average of about 75%. Think about what that means for your household budget. We're not talking about a small percentage point or two. We're talking about hundreds, possibly thousands of extra dollars you'll be forced to pay every single year just to keep the same health coverage you have right now. Consider the stark reality unfolding in Washington state. State regulators have already approved an average 21% rate increase for individual health insurance plans for next year. Now, layer on the expiration of these federal tax credits. For a Washington resident who currently relies on these subsidies, their premiums could skyrocket by a massive 65%. That's a brutal hit. A family of 3 in King County, bringing in about $52,000 annually, might see their yearly healthcare bill explode from around $490 to over $2,800. For a senior citizen in Yakima County, earning about $41,000 a year, their annual payment could soar from a mere $70 to almost $2,000. These aren't isolated incidents. These are real people facing impossible choices. Rural communities in Washington could experience premium surges of 80% to 90%. And this isn't just a Washington problem. This financial squeeze is playing out across the entire country. In North Carolina, almost 900,000 residents could face significantly higher out-of-pocket expenses. The average enrollee there could be forced to pay roughly $670 more each year. More critically, an estimated 157,000 North Carolinians risk losing their health insurance entirely because they simply won't be able to afford the inflated costs. Meanwhile, in New Jersey, over 450,000 residents could see their annual healthcare bills increase by an average of over $1,200. In Wisconsin, the enhanced tax credits currently save more than 230,000 people about $500 every single month. Without those credits, individuals with mid-level incomes could face premium increases ranging from about 30% to a shocking 160%. Even those with very low incomes who currently pay nothing might suddenly face a monthly bill of around $30. The reason for this looming disaster is simple. The enhanced tax credits, originally implemented in 2021 as part of the American Rescue Plan Act during the pandemic and later extended through 2025 by the Inflation Reduction Act, are set to expire. These credits were designed to make health insurance more accessible and affordable, especially for middle-class families. They eliminated the dreaded subsidy cliff, a situation where earning just a little too much income meant losing all financial assistance for healthcare. They also capped how much of your income, around 8.5%, you would have to spend on premiums. Without these caps, millions who previously found coverage accessible will suddenly be priced out. Who are these millions of Americans who will be hit the hardest? They are not just any segment of the population. We're talking about students, independent contractors, the self-employed, small business owners, and early retirees who aren't yet eligible for Medicare. In fact, nearly half of all adults under 65 who use the Affordable Care Act marketplace are either self-employed entrepreneurs, small business owners, or work for small businesses with fewer than 25 employees. For these hardworking Americans, the individual marketplace, bolstered by these credits, is often their only reliable source of comprehensive health insurance. Unlike larger corporations, small businesses frequently cannot afford to offer health benefits, leaving their employees and owners vulnerable to these market fluctuations. Let me lay out some real-world examples to illustrate the severity. Imagine a single 50-year-old adult earning about $40,000 annually. Their monthly premiums could leap from around $150 to almost $300. That's nearly double. Consider a single parent making roughly $60,000 a year. Their monthly payment could surge from about $270 to almost $490. A family of four with an income of about $70,000 a year might see their monthly bill skyrocket from around $140 to almost $440. That's more than a 200% increase. And for a 64-year-old couple bringing in about $90,000 annually, their premiums could blast off from around $640 a month to over $2,600. That's an astonishing increase of over $24,000 each year for the exact same policy. How do you plan for retirement with that kind of financial shockwave hitting you? The political battle over this issue is intense and deeply divided. Democrats, including Senate Minority Leader Schumer, House Minority Leader Jeffries, Washington Governor Ferguson, Senator Cantwell, and North Carolina Governor Stein, are strongly advocating for extending these enhanced tax credits. Some Democrats are even threatening a government shutdown at the end of this month if a deal isn't reached on healthcare. They argue that it's morally bankrupt to let these credits expire and that it would undo years of progress in lowering the national uninsured rate, which hit a historic low of under 8% in 2023. On the other side, many Republicans, particularly those from the conservative House Freedom Caucus, like Representative Andy Harris, are firmly against extending the credits. They view them as temporary, pandemic-era spending that the nation can't afford, citing estimates that making them permanent could add over $380 billion to the federal deficit over 10 years, or about $40 billion annually. However, not all Republicans are unified. Some moderate House Republicans, often from swing districts, recognize the political liability of letting these costs explode before next year's midterm elections. They've even introduced legislation for a one-year extension, hoping to push the problem past the elections. Senate Majority Leader John Thune and House Speaker Mike Johnson have expressed some openness but are non-committal, with Thune indicating he prefers a clean funding bill and would want Democrats to propose solutions. President Donald Trump has yet to take a public stance, though his pollsters have warned of political repercussions if the subsidies lapse. Beyond the subsidies, other factors are driving up healthcare costs. Insurers are already proposing an average 18% premium increase across the country for next year, partly in anticipation of these credits ending. They fear that if costs rise, healthier, younger individuals will opt out of coverage, leaving a sicker, more expensive pool of patients for those who remain insured. Hospital consolidation is also playing a significant role. As former insurance executive Wendell Porter points out, fewer competitors means large hospital systems gain more leverage in negotiations with insurers, driving up prices. For instance, Regions Blue Shield is pulling out of several Washington counties because they couldn't agree on reimbursement rates with PeaceHealth, a major provider, stating they were asked to pay 3 times what Medicare pays. The clock is ticking down to critical deadlines. Open enrollment for next year's Affordable Care Act plans starts on November 1st. However, the real sticker shock will hit millions of households in October when you receive official notices detailing your monthly premiums for the coming year. If Congress fails to act before those notices go out, they will reflect the dramatically higher costs without the enhanced tax credits. This means you will see a much larger bill before lawmakers make a final decision, creating immense uncertainty and anxiety. So what can you do? Be prepared. When those notices arrive in October, do not ignore them. Review your plan options and the new costs with extreme care. If your current plan becomes unaffordable, you may need to consider switching to a cheaper, high-deductible plan. These plans typically have lower monthly payments, but require you to pay much more out of pocket before your insurance benefits fully kick in. They serve as a safety net against catastrophic medical emergencies, but they mean you'll be on the hook for more of your routine medical expenses. The future of these critical healthcare tax credits remains highly uncertain, and the stakes could not be higher for millions of American families and small businesses. A vast number of people who buy their own insurance, almost 60% according to some reports, are not even aware of this looming change. This isn't just a policy debate, it's a direct threat to your financial stability and access to vital healthcare. Stay informed, speak up, and know your options. Your health and your finances are on the line. If you found this information helpful, please give this video a like, subscribe for more crucial financial updates, and hit that bell icon to ensure you're always in the loop. Thank you for tuning in, and I'll catch you next time.